Good afternoon, everyone. I'm Jeff Nessler, the Wellness Activity Manager from PSS, and I'm here to introduce you to Money Made Simple, Understanding Credit and Debt Management Before and After Retirement. And here to lead the session today is Jim Burrow.
Hey, thanks, Jeff. Thank you very much. And thanks everybody for being here. Again, welcome. My name is Jim Buro. I'm kind of a guest presenter today. And just to give you a quick overview, we weren't here last week with Anthea Perkinson. I'll tell you a little about Anthea also. And the program itself is it's really a financial literacy program that Anthea devised. It sets alone as its own nonprofit, but she describes it as being currently in residence at PSS. So it's fairly exclusive to PSS. And it's really a series designed to help anyone with financial literacy, specifically the people that are associated with PSS and how it might be appropriate for your individual circumstances. So again, that's periodic workshops that she does. It's also areas to talk about specific areas of finance. I think this is designed as a 4 or a 5 session program covering budgeting and credit, investments, taxes, and really kind of pulling things all together in a final session. And what I'll note, and we'll have a reference to a page later, is that there's also some pro bono financial counseling sessions that are offered to address any topics that are covered here. And I'll give you that website and that information in a couple of minutes. So here it is. Again, currently we're in residence at PSS Circle. There's no cost. And if you go on the website, this www.pssusa.org backslash or forward slash MMS, which is Money Made Simple, you can sign up for a free 30-minute counseling session. Anthony, I believe, is someone who does that. That was your presenter last week, and a number of other people that are part of that to sit down and basically just be there for you, ask questions of you, and have it go the other way around, trying to find out maybe where you are and if there are some specific needs so they can tailor some recommendations or process that you might go through in terms of maybe sitting down with another professional for a longer session. That might not be a free session, but at least will get you moving in the direction that you need to. But that is a full free complimentary session as part of this service to get you started if there are specific things you want to address and questions from what we talk about. So today, I think last week you did budgeting, which is kind of like finances 101. And we're going to make some callbacks to that in terms of what that is and how that relates to this process, which is understanding credit and managing debt before and after retirement. And we often think that it's more important to do this before retirement because in many ways you're developing the habits that are going to carry you through the rest of your life. But it also becomes important because when I think to like someone like my parents who never really had credit, which in many ways was a blessing, but also sometimes can be a curse. They were cash basis in those days, and they just kind of never had an issue. So they never really were in debt. They had a small mortgage that they had privately, and they paid that off relatively quickly. Later on, it became a bit of a challenge when it came to making large purchases. So we'll talk about why it's important to establish credit in the first place, that it's something that is somewhat necessary, especially for large ticket items like a home, which they were able to do, again, privately, but most people can't. And also things like car purchases, significant purchases that relate to why a credit rating is important. And we'll talk about some of those things and why that's important for your finances. So the agenda again, why should you think about credit? How do you manage it? And we'll talk about some of the credit rating agencies, what a score is, maybe how that score is compiled, and how you have the ability to influence that score. Sometimes we think it's a black box, which it can appear to be, and somebody just throws you and categorizes you based on a number. So it's a little cold and cruel. But the reality is there's a lot of things that you do to contribute to that score, and you have control over to improve that score. And we'll talk about the benefits of improving that score. Another is debt and debt management. If you get into debt in the first place, ways to manage it and ways to get out of it and how that impacts your credit score as well. So it all goes back to kind of bullet point 2. How do you manage credit to keep that score healthy? And if you get into debt or have a significant debt issue, what's the most effective way to get out of that debt issue and keep that score the less impacted by those steps to get out? Again, some practical tips and resources. And if we have time, there's an appendix that talks about identity theft. So that will be kind of like a little icing on the cake. I'm going to set my timer so we know that that I'm on time in terms of what we're doing. And here we go. Let's see. I want to go to the previous slide for a second. Okay, so we talked about that. So why credit in the first place? Like, why should we think about credit? Well, it basically is something that allows you to buy, it says goods and services, things that you need without paying for them first. And again, my parents would often say, like, why do that? If you can't afford it, don't pay for it. But we'll see. It's really the second bullet that becomes most significant. It allows you to finance large acquisitions, large ticket items, like a mortgage for as one example, but also car loans or leases, and then other things that you might, not either anticipate, either sudden medical expenses or expensive, large medical expenses that have to be financed or paid for over a period of time. So it's important that credit gets established. And we're going to talk about, again, how to do that effectively and how to sustain a good rating. So managing credit, assuming you have a card, or we'll talk about ways to get a card or more cards. Um, what is it that is going to impact you, and what have you done to contribute to that? So one is this thing called a credit report. So the difference between a credit report and a score, the report is actually an independent company. It's actually three different major companies that report to different agencies that are checking on your credit to see how credit worthy you are, and mostly they do that to see what your ability is to repay. So again, the report itself is a detailed history of all your loan and repayment activities. That could be through credit cards, store cards, bank cards. And again, if there's any late payments or judgments or defaults against you. As far as the score itself, they say here it's a number between 300 to 850. It summarizes the activity on the credit report. So it really is a way to um, put a hard number so they can quickly look at that before they start to really drill down into the report to see exactly how that number got generated. And again, this is a bit of the magic of it's used to predict future repayment behavior and therefore to price the cost of credit. And it says interest rate charged. So effectively, why credit can be good is for the ability to have access to money, to be able to do things that you might be able to pay off through installment loans, things like a home or a car or a big purchase. Um, but it also becomes this blueprint of your behavior, your financial behavior around your not just ability to repay that, but also your behavior in repaying it. So there's two different things. You're saying, Mike, I can repay it. They want to say, show me. And that effectively is what you do in terms of meeting your monthly payments on things that are installment related. And it's also going to be some for what they call revolving credit, which is really typically unsecured debts that are credit cards for things you just might purchase out of convenience that you don't pay for immediately, but have a revolving line of credit with a credit card company. And we'll talk a little bit about what that is. And again, how people look at that when they're looking at your report. So again, they talk about what are they looking at when they pull this information up? Name, date of birth, social security number, uh, employment history, home ownership, past addresses, what your payment history has been, and then if there's been any inquiries on your account. And here they kind of differentiate between what they'll call a hard inquiry or a soft inquiry. The hard is actually, let's pretend I'm going for a car loan, which I'm actually going to be doing shortly. And that will put an inquiry on my credit rating that will literally remain on that rating for a year. So the agencies aren't set up where they want to micromanage what's going on in your life, but they want to know where there's serious turning points or inflection points that might relate to larger purchases and how you're going about handling that at the point of transaction. So the soft is, lenders may give you pre-approved things in the mail. You may access some of those things. Those things in themselves do not impact your credit until you take an action to specifically open a new card or get a store card or whatever it might be. And the frequency of that activity and the size of that activity will start to impact your credit rating. And we'll talk about how that actually happens. And then if there's anything outstanding as far as public documents against you, whether it's a bank foreclosure or a judgment against you. So these are just things to be aware of that are going to impact your credit, to show what the agencies have kind of collected, what they're looking at, and also what your daily, weekly, monthly, annual behaviors are that have contributed to some of this information that they have on their records. The three main companies are Experian, TransUnion, and Equifax. And it goes through a whole thing about how they pulled this information together. You can see it on the screen there. They also respond to, it says, to background checks and employment checks, and they carry so much data. So they're relied on by a lot of different organizations that are looking at them. That's kind of the good news, bad news. I mean, it's good that there's three companies out there. They have responsibilities and they have to make sure that they are accurate in the data that they record. So there's a lot of privacy around this data. And again, you control to a large extent what gets put into those reports and how those reports get created. the score itself, and I guess it's not listed here. I thought I saw it on a previous slide. It's called the FICO score. It's kind of an acronym for a company called Fair Isaac, which actually came up with the formulation of that score between 300 and 850. And again, we'll talk about the variety of inputs as to how you can um, see your score, but also how you can control your behaviors in impacting that score. So what this talks about is what your rights are in accessing your own credit reports. This is under federal law. You can get a free credit report every 12 months from each reporting agency. So one of the suggestions is to kind of rotate that. Maybe every 5 or 6 months, go into the portal that will show you and access a report from Experian. And 6 months later, go to TransUnion. And that way you can actually be accessing your credit and taking action on any information that might not be accurate as you go, instead of waiting a full 12 months and just ordering 3 reports. So it's actually a staggering of the reports. And again, you also are entitled to a free report immediately if you've been denied a loan or job insurance, if you're unemployed, or if a report is inaccurate due to fraud, including identity theft. So often what happens is, and we got one of these notices a while back, if you have investment accounts, oftentimes, uh, sadly, information databases of third-party companies that you do business with, it could be your bank, it could be a brokerage firm, may have their own systems violated where some of your personal information is at risk. And oftentimes what they will do as a bit of a stopgap is to alert you, hopefully legally, as quickly as possible if information has been breached or identity information has been breached, and to allow you access to these reports or a service that complements these reports at no cost to you. So that, again, is more specific to incidents that may happen that may affect you. So it's just another way that not just the agencies collect and report information, but also some of the people that serve as custodians for your assets will, again, based on what they decide is appropriate, give you some access to some resources to protect your identity and how it may impact your credit. Okay, so this is a very important slide, and if you maybe do nothing else, is maybe just take the screenshot or the picture of the website, typing it into your browser as is, like annualcreditreport.com. Maybe even put the WWs in there so you don't allow anything to chance in a search box. And the reason is because, like anything else, when you're searching for something, there are vendors out there, sometimes legitimate vendors, mostly legitimate vendors, I hope, that are trying to, sell you something based on the words that you're using. But in this area, it's more important, because what if, you're on a site that's not this approved site, that is just asking for very personal information that is going to subject you to identity theft. So again, this is not an identity theft seminar or webinar. It's really to say, just to play it safe, go there. You won't be fooled. Um, and select one of the 3 agencies. And again, the suggestion is every 4 to 6 months, request a report from a different agency so you can have that rotation every 12 months where you still can go back to Experian or go back to Equifax or go back to TransUnion. And again, there is a number to call. Uh, you may feel more comfortable making the phone call again. You will be asked for specific information, including that social security number. So be aware that the information on this page is as far as you want to go in terms of discovery over credit searches on yourself. And again, the actual ordering by you of the credit reports does not impact your score. It's really at the time where you're going through third-party companies where you're looking to apply for loans and things, where your score is going to be impacted, whether, again, that's a hard search or a soft search through another company. These do not impact your score at all. Okay. What's on your credit report? So basically, if you've seen one of these, and oftentimes if you actually go, like we'll go to the car dealer, I'm sure he'll just pull out our credit report and he'll show different things. But you can do this yourself. And again, the suggestion is try to do it a few times a year. Open and active lines of credit, total outstanding balances, and maximum credit available. You're going to find out that that second line there is a critical line in terms of understanding, excuse me one second, in terms of understanding where you are and how you might be positively or negatively impacting your credit report. Total monthly payments and minimum payments. Because oftentimes what a new creditor will look at is, what is your capacity to pay? And what's the trend been? Are you opening up more lines of credit recently? Are you opening up credit to pay off other credit? That's something that can become a trap both for you personally, but also they'll be sensitized to that and be less inclined to lend you if they see that there's a recent trend of a number of cards being opened up. And then This is more for your score maintenance. Like, what's the mix of credit? Do you have a mortgage? Do you have credit cards? Do you have loans? So the mortgage obviously is secured by a home. Credit cards typically not. That's revolving credit. It's unsecured in most cases and more vulnerable to be not paid back because there's no way that someone can come after you for making a purchase, or in most cases can't come after you for making a purchase that's unsecured. There's nothing to secure the material. You probably either used it or spent it or consumed it. And then other loans. And were those loans installment loans, or was it some sort of kind of a revolving credit? And then delinquencies. Have you had bad credit before? The good news is there's a time limit to how long delinquencies and bad um, happenstances to your credit can be removed from that account. But if you've had some of those, it's going to impact that score as well, and any court judgments that are held against you. So again, these are inputs that you control that are going to be recorded and kind of stay with you for a long period of time. So who uses it? Again, it can be anybody that's looking to determine what your ability to repay something is. So it could be a landlord, it could be the utility companies, cell phone companies, car loan, clearly, car insurance, and also on the list, it says the list continues to grow because it's anybody that's looking to establish a financial relationship with you where they may be held, um, you may be held liable and they may be held on the short end of your ability to repay. So this is an interesting slide. It talks about credit scores and this FICO score and where they've gone. And what it shows is kind of positive. It says that in the last 10 years, from 2012 to 2022, on average, scores have improved, right? It said it shows this increase of 750 or over. It's those first two bars, the long bars on top, where it's gone from something around 37.5% to almost 47% in terms of an increase in overall people that are getting better scores. I think, and I had a side note on this, so let me take a quick peek at that. I think some of that um, has to do with uh, the financial crisis. And during the financial crisis, I'm not saying everyone received money and paid down debt, but there was an inclination for people to be a bit more conservative due to uncertainty. And there was some money, some stimulus money that came around that actually contributed to that. I think there's a chance that we may see those numbers possibly regress a bit as people come off of stimulus payments, but also because of inflation and also because of higher interest rates. All of a sudden, things that we didn't experience as a country for the better part of a decade, very low inflation. For those on Social Security, you were not getting big Social Security boosts probably from 2010 to 2020. So inflation was a bit of a double-edged sword for people on fixed income. It really helped as far as bumping up your Social Security income. But in general, that's a lot of that is offset by higher costs for what you need to purchase. And also, if you are, balancing credit or balancing payments to other people, to creditors, higher interest rates are going to eat into that. So the score is critical. Good news is it's been trending higher. And I'm cautiously optimistic, but a little bit pessimistic that maybe that starts to reverse a little bit based on higher costs and higher interest rates. Okay, let's keep moving along. And Jeff, if there's any questions, please, I think we can handle them as we go if something pops up. And if not, we'll try to block some time at the end. So here's kind of a big one and why this matters to a large extent. And it could be with anything, it could be with the car interest rates, but this is focusing on the big purchase, which is typically, the home mortgage. And they use a modest mortgage balance. I think that's pretty modest today of $300,000 over 30 years on a fixed mortgage. And it shows you this number. And it says if your credit score is the top 760 to 850, they show an interest rate of 4.03. P.S. This slide was probably put together a little while back. So right now, you're not finding these rates on 30-year fixed mortgages. Rates are sadly substantially higher. I think you've got 30-year rates that are close to and or over 7% right now. But if you went with this just as a point of comparison between the high credit score and the low credit score, which is really the point of the slide, what you're seeing is that if your interest rate was a little over 4%, 4.003%, your monthly payment is $1,433. And if you're in the worst category, it would be about 5.6%. So for that 2.6% interest rate differential, the monthly payment is different by, I think it's $290 a month. Well, if you multiply that $290 a month every month by 12 months, that's a number. And then by 30 years, the difference is $104,400, I believe, over 30 years. So, there's this expression, the rich get richer and the poor, pay interest or pay a lot of interest and have issues. This is really why, because it's kind of insidious to look at the rates themselves without monetizing or putting a dollar value on those rates, what the impact is. But also, if it's a very long maturity on the loan that you have, the compounding, in this case, the negative compounding, not a benefit, a disadvantage of having a higher interest rate. So that's not trying to, say anything new. It's basically just saying, hey, this is reality, especially with rates being high now. You're suffering an even greater, I'll call it a penalty, even though it's not legally a penalty, by having a lower credit rating and subjecting yourself to an even higher interest rate at a time when prices are high. So things are working against us as consumers right now, unfortunately. Okay.
Are the free credit reports inclusive of the FICO score?
Yes, yes, you'll see that. That'll probably be the first thing you see is what is my score? And you actually, I mean, I'm not saying suggested, but if you went into it and you were looking for a car, someone else will pull the report up for you. They'll say we just pulled up your TransUnion or your experience score, but you can do it yourself. I said I'll go back to the slide. This annualcreditreport.com. Go to there and just make the request from Experian. If you haven't done it in 12 months, there's a free report waiting for you. Pick either one of the three, and it'll show the number first, and then it will literally show the exact same thing that an auto dealer will pull out. Say, well, I see that you have 5 credit cards and you were slow paying on this. You'll see effectively what they see when they look at the report. So yes, you'll see the score. You'll absolutely see the score. And we're going to talk in a minute or two about how to really, like, where does that score come from and how to really change the score. So here it is. How do you create or improve a credit history in order to obtain a good score or to improve a score? So we already have scores if we're of any age where we've been using credit. So number one answer is pay your bills on time, right? So as that relates to credit cards, try not to, if it's really a credit card, try not to pay interest if you can. I mean, we'll talk about what a credit card is versus what um, a store card is versus what a charge card is. The difference between the two, some have to be paid, some don't. Credit cards, revolving lines of credit don't have to be paid. They'll give you suggestions on a minimum payment amount. But if you really look at it, look at immediately, what is the interest rate? And sadly, almost regardless of your credit score, those rates are onerous on credit cards. They're extremely high. I mean, I think I've seen them like 29%. And we'll look at it. We'll look at a breakdown as to a suggestion. If you've got credit card debt, what's the best way to not only get out of that debt, but also a way to positively impact your score as you're getting out of that debt. So kind of a double win. So pay your bills on time. That was my parents' philosophy, right? It was never have credit, just pay all your bills as they come in. Correct any mistakes that are on your report. You have the right to do that by communicating with the 3 credit agencies. Apply for a card, use it responsibly. Obviously, don't incur late fees. Typically, if you incur a late fee with a credit card, you also incur interest. So when you get the statement, it'll say interest penalty or interest charges, late fee penalty, and again, just like gobbling up chunks of money. Make your student loan payments on time. I know there's been some forbearance there, but see what's going on there. If laws have changed recently, I think something has changed recently with the payback on student loans. Just get up to speed on that as best as you can. Make sure your credit rating is not being negatively impacted if you have not resumed payment, if you legally needed to resume payment. Understand paying a collection agency will not remove an item for your report. We're going to talk about that. There's going to be ways out of debt, and there's going to be probably 2 or 3 that are kind of DIY, do-it-yourself methods. There's going to be ways to get debt counseling for free from services or for very limited money, very like just a pay for someone's time to help you. And then there's also other ways that we would suggest you don't do it, where people are like debt consolidators and they want to try to help you get out of debt. But we'll talk about why that's probably not a way you want to go. But we'll come to that in a few minutes. I'm just going to throw this up there, not talk a lot about it. I would say spend some time with this dfs.ny.gov. New York State, if you're from New York State, you live in New York State, you in many ways are fortunate over some other states because New York State and their Department of Finance is, I think, second to none in terms of things that they do to protect the consumer. This is kind of a mantra of the state. So all politics aside, I think it's been there for decades. Where come from whatever parties in power, they've done a good job over time to maintain this site and the services, and really kind of a watchdog on consumer issues around finances. So they're there to primarily protect the consumer. And it's just a wealth of information. And we'll see later a couple of quick slides on ways that that might impact your credit score and your credit rating and your credit history. So here's a very important slide too. I think the first one was, like, look at that interest rate. That's critical. Pay your bills on time. Interest rates will eat you alive. Late penalties will eat you alive. This tells you how you can actually impact your score by telling you where your score comes from. And a huge chunk, not unexpectedly, are is your payment history, your ability and your behavior in paying. So 35% of that score is, are you paying your bills on time? Like, are there no late fees? Are there no charges? The second is the amount you owe. Do you max out your credit limits? All it says here is that's 30% of your score. In the next couple of slides, we're going to talk very specifically, and I think it's a great great work that Anthea did here, very specifically about what does that mean? Like, I have a credit limit. How close should I be getting to that limit? What happens if I go over that limit? So amount you owe, and are you maxing out limits? Because that may give the next creditor in line a concern that you're, kind of borrowing from Peter to pay Paul, if that expression is still being used, to, you're opening up credit to pay down other credit just so you don't get close to these maximums on your cards. That is not a spiral you want to be in. It's not a good, healthy spiral. The length of your credit history. So like I said, for my folks, they were later in life, really never had a credit card, and truly to have them rest in peace now, that they really never needed it. They always were able to kind of handle things. And that really never presented any huge challenges. For most people, it does, because of just how expensive things are and the fact that you need to make some larger purchases. So the longer you're at it and the longer that you have a good behavioral record, that counts. I mean, to the point of 15% of that score. That's why it's more important to get an account, a couple of credit accounts open sooner than later, just to be successful at it and to show them that you want to contribute to that score. Applications itself, it says it's 10%. Usually that's a negative. Like, the more applications can be perceived to be negative because too many are coming in too quickly, and that's going to pull that score down a bit. And then the mix of credit, again, types of credit you have, revolving versus installment. So again, revolving would be that typically unsecured credit card debt, and the installment would be the big things like your mortgage, like your car. I think they're an equal opportunity, observer, Experian, and the people that are looking at these reports. They just want to make sure you're doing prudent management of your money. That if it's a fixed obligation like a mortgage or a car payment, you're meeting it on time, and you're not having liabilities that can't be paid off. And if it's the revolving credit, that you're not doing things consciously, hopefully, to incur late fees or interest fees. And I would also say, I'll probably say it again later, if you slip, I've slipped, call the company and say, look, I don't slip, I don't miss. Yes, I'm not infallible. I made a mistake. I was out of town, or I just zoned out. I came off my computer. Call them and say, can you please remove the interest rate charge? And can you please remove the late fee, because my payment got there 2 or 3 days later? I mean, that's kind of the funny thing. I always think, there's a date out there where you've got to pay. And if you don't pay by that date, you get assessed a late fee on your credit card. And you're also assessed interest at a very typically an exorbitant rate. And yet you could pay it 10 days early and no one gives you money. They don't credit you money for being a good person who's behaved very well by paying a week early. I'm going to say you probably want to pay a good, 7 to 8 days before a deadline, maybe even a bit more, just to make sure you don't get too close to the deadline. So don't try to game it too much and get too close to a deadline, when those fees are going to be tougher to reverse on the back end, and they will have a negative effect on your rating. So here they go. Amount owed ratio, talking about the importance of slides. This is a biggie also. So this is probably my third most important slide. Using more than 50% of your credit limit is not a good thing, right? So it's kind of a bit of a strike against you, only to the point where it's that percentage of your score. So if 30% of your score is going to be subjected to how much you approach your limit, be aware that 50% is kind of in the back of their minds. So avoid multiple cards within a short period of time. That's the second thing. But let's go back to the 50%. So that's if you have a credit card that has a limit of $10,000 on it. They're pretty much saying you don't want to push that thing to have any type of an outstanding balance greater than $5,000. Now, I would encourage you to have a zero balance on it. Have a credit card that's got a $10,000 limit and use it if you have to. You're going on a big trip, you want the points on your card, a rewards card, you might take it up to 5,000. Try not to take it over, but you could. I mean, and as soon as that bill comes in, make sure you've got the money to pay that 5,000 and it's gone. Because if you don't, and you pay on time, there'll be no late fees, but there will be interest. And that'll be much more difficult to get that balance down. So you're not going to be really negatively scored on paying interest payments because that's keeping, some credit card company happy out there that you're making your payments and you're paying them interest. That's why they've allowed you access to credit. But better for you that you pay neither. Always on time and always in full. Maybe that's a good expression to keep in the back of your mind. But try not to exceed, even if it's to get those points for a big purchase, try not to exceed that 50%. And if you do, I think my wife and I did this one time because it was just confusing. We were trying to buy something that had all these reward points and we got it. And I think we paid it like immediately, like with the next day, we just paid it off. But we did the purchase to get the points and immediately just tried to pay it back down. So that's a negative impact. And again, having multiple cards in a short period, I think you might be trying to um, protect yourself, and or you might be in trouble already and you're trying to use more cards to pay off existing balances. So be careful of that trap. I've seen that trap before. I've been very close to that trap before. Personally, when I was much, much younger. Positive impact, using less than 30% of your credit available. So the reality is, as I said, if you get close to 50, you're okay. You go over 50, they start to probably deduct a couple of demerits, a couple of points against you. But if you keep it under 30%, so that same $10,000 credit limit on a card, and you're under $3,000, even in any of your usage, even if you pay it off completely, that's much better. So that's the window I would kind of play in. Keep that 30% is really getting into the territory where you're not in really a danger zone. The danger zone kicks in as you go above 50, but under 30, you're actually accruing points. You're improving your credit score. So yeah, you can have more cards because you might have larger purchases as your wealth increases, but try, and that's the reason to have more cards. Try to keep those balances at that 30% or lower, and then asking for a higher credit limit on current cards rather than applying for several new ones. That's great because the credit agency sees that you had a $10,000 limit, all of a sudden they raised it to 15, and that helps you out because now instead of only being able to take your card, what I say, conservatively up to $3,000, right? 30% of 10,000. If you take 30% of 15,000, you could take that up to $4,500 in a purchase and still be having a positive impact on your credit rating. So that's the reason why it makes sense to raise the limit. Ask your credit card company to raise the limit. Sometimes they'll
Question.
just do it for you. Yes, sure.
Raising the limit, is that based on your income? Because a lot of folks that are retired might not be making what they made when they were working.
Yeah, and my gut is it's not based on your income because uh, it's really based on your behavior in terms of how you've paid. So they might not know that your income has changed. Someone really may not know if you've left a job or if you've retired, if your income has actually changed. What they look at is what is your behavior. So it really is about what you have been able to do. So we got randomly, probably from our main bank because we bank there. We got a credit limit increase unsolicited. We didn't ask for it. They just did it. And our income didn't change at all. They just saw that our behavior was such that we probably were starting to make larger purchases with their card. So for them, we know that the banks, their fees that they charge to the vendors, right? They can make money not just from me, paying interest on a card, but they can make money from a vendor that uses the card as a facilitation to a transaction. So they can get a fee from the vendor. So they want you to use more credit. So they're encouraging you by increasing your line. But no, it's not driven by income. It's driven by your ability and behavior to continue to pay. So that's really how they're increasing it. So yeah, my thought just on your question, maybe it's the question behind the question is, they're not going to penalize you for the fact that you've retired, that your income has gone down. They're not going to lower your credit ratings. They're only going to change something based on your behavior in terms of what you pay versus what you owe. That's okay. So I see another hand up possibly there, but yeah, but that's really the answer there. It's not income driven.
Okay.
It's behavior driven based on payment.
I always had a low amount of money that I owed every month, and I paid everything. But
Right.
then I decided to purchase some funeral expenses for my parents when they
Okay.
were in their 90s.
Okay.
And so I purchased one, and it was like $12,000 in Manhattan to bury somebody, and I
Sure.
paid everything in advance. And my credit score went down like 100 points.
Hmm.
and doing something that I thought was the responsible thing to do, which is pay funeral expenses before I had to. And I called them up and I argued with them, and they finally put it back up about 50 points. So what do you do about those expenses that are, I had a credit limit of about $20,000 and I exceeded that 50% credit limit that you were talking about.
That's exactly. So I had not heard that before. So thanks for sharing that with me. And I might do some digging around to see if I get any more, anecdotal information to support it. I was going to say, ask them why, if that was the answer. It sounds like that was the answer, that they probably looked at your, your behavior, which probably was, just excellent to keep the number as high as it was. And then all of a sudden saw this outlier, like a large amount of money going towards something that did two things. One, it was an irregular or not routine expense, and it took a credit line that you had to a higher level where it threatened to score. That seemed the 100 points sounds, again, I'm not the agency. I don't know what goes into the little black box, but that seems like an extreme amount. It sounds like you clearly did the right thing in letting them know that was, there was a specific reason behind that. It's probably why they restored it. It's probably why they didn't restore it all the way up, because they still said, hey, still have to look at the math, and the math took you over that 50%. That's my best guess. It's not a guaranteed answer in terms of why they did it specifically, but that would make some sense to me, that it was an irregular, fairly large expense that exceeded their threshold where the numbers can start to work against you. It's important to know that if you get closer to some of these thresholds, it's going to have a negative impact. And the other way around, it can have a positive. And between you and me, this is crazy. Anthony and I have been in the business together for many, many years. I did not know these numbers. I did not know the credit thing, because I probably had a lot of my parents in me, which is in many ways excellent, and I'm very happy about it. But it was like, if you don't have debt, you don't have to worry about any of this stuff, right? But there's a reason to have the credit. There's a reason for the purchase. There's the reason, in Grace's case, to have that money available to do the things you want to do and to provide for the people that you care about. So yes, I was not aware of this magic formula, and I know I violated it over the years, and it's probably hurt my credit score a bit. But I've done some things to try to work it back up as well. Okay. It just tells you a little information here. I'm not going to spend much time on about how long this information stays on your profile. 7 years for this piece of activity. For liens, if you file a bankruptcy, they talk about a Chapter 7 bankruptcy and a Chapter 10. I'm just going to talk very quickly about what the difference is between these two, because people get a little bit confused. The Chapter 13, the difference is in that word. There's a repayment plan that's filed. So a Chapter 13 bankruptcy, I'm going to read off of some notes I had here. It allows you to catch up. This is kind of the key line. It allows you to catch up on secured debts while also discharging unsecured debts. So it basically is saying, like, if you have a home and you have a car, it's going to allow you a payment plan to catch up on meeting those obligations, not losing your home, not losing your car, and a way to discharge in a legal bankruptcy, to discharge those debts. If it got this bad where you couldn't find a way out, you couldn't do debt consolidation or debt management to get out, and you had to file some sort of a bankruptcy because the numbers just weren't working in your favor. You didn't have enough income and couldn't see enough income in the future to kind of offset the liabilities that you already put in place. The Chapter 7 says it remains on for 10 years. That's pretty onerous. It's on your record. And that's really like, it's just a full, wiping out of all your debt. Obviously, that's a much worse outcome. As far as your credit rating goes, my understanding is that they both affect your credit rating the same way. They're both big negatives, but somebody looking at the report might be inclined to say, at least with the 13, you took responsibility, you set up a repayment plan, you protected your key secured assets, and people would look at that as somebody who was, I think, being more fiscally responsible and just saying, I'm throwing my hands up in the air, I've got to declare a full bankruptcy. And none of these are good outcomes from your credit rating standpoint. But if you had to, and you couldn't work it out in ways that we're going to suggest in a minute, in terms of trying to get out of debt and restructure things to get to a better place, a 13 clearly, although not technically better from a credit rating standpoint, is better psychologically for yourself, but also to hold on to key assets where you don't have to just kind of start from ground zero again to try to rebuild yourself financially. You hold on to the secured properties that you own, you work out a payment plan, and you try to have everything else just, again, lost in bankruptcy. Okay, so here's what I said about New York, and it's just a blurb about that. Judgments, paid off collections or charges only remain on your profile for 5 years. So on this previous slide, it said if these things impact you negatively for 7 years on your profile, in New York, again, only New York residents, it's a 5-year remain. So again, I say this is New York, doing the best they can to advocate for their citizens and for their consumers. So again, that's why spend some time on that DYF site, the Department of Finance site for New York. A lot of information there about what New York does that is actually better than maybe what other states are subjected to. So real quick, we talked a little bit about this just to give you almost definitions, the types of cards that are out there. If you're going to start to use credit or have used credit, pure credit cards that usually have some sort of they could have a bank associated with it, but usually it's the big three. It's Visa, MasterCard, or Discover. A charge card, usually from a company like American Express. They call it the green card. They have other different color cards, but we'll talk about what the charge card is and what the difference is. And then store cards. And it says here, notice in the big bold print, charge cards must be paid in 30 days. So the charge card almost acts like, I'm going to say this because it's not legally a debit card, but it almost acts that way. It's like you go out and you don't have the money in an account. You're basically using a card that American Express says here, you've got a $5,000 or $10,000 credit limit, and you can use the money up to that limit, but it all has to be paid off effectively. There's no revolving line of credit. So it truly is a charge that's made with the anticipation that you're going to pay it back. And if you don't, it's going to start to look like a credit card with fees and penalties, et cetera. But it was never intended to be a revolving line of credit. For credit cards, they are set up that way. So it's almost kind of designed to be a revolving line where they're probably expecting you to pay some interest because you're not going to pay the entire balance off. Not so with a charge card. And the only differentiation they make with a store card is it could be either or. So you want to ask a store, if a store like Bloomingdale's is saying, hey, we'll give you a charge card. Is it a charge card? Is it a Bloomingdale credit card? Because I know Bloomingdale's firsthand does both. They have an in-store card, and I believe they have actually they might both be credit cards now that I think about it. But they have like an in-store card for in-store purchases and an out-of-store card. I think they're both actually credit cards. Neither one is a charge card. But again, speak to the vendor themselves, speak to the store if you have an affinity for a specific store. Oftentimes those can be good because of deals that they'll give you, rewards for your loyalty to be there and buying through them. But try to find out, is it a store card that needs to really be paid off, or I'm sorry, a charge card that needs to be paid off, or is it a revolving line of credit that I suggest you should pay off, but you don't legally have to in terms of the revolving nature of a credit card. And then they call secured cards. I mean, it says make sure that these things, if they're not fully recognized, that they are reported to the credit agencies, the Experians of this world. These can be cards that they're typically, like it says, putting money on account. It's really the second bullet that's the most significant. It is almost acting like a debit card. You have money on account that serves as a credit limit. And what they say is when you get the bill, don't pay the money from that deposit that's on the account. Pay it from other money to show that you can develop a habit or a behavior of paying on time so that you can, quote unquote, graduate to a real credit card. I have not really encountered any of these. But I know it's a mechanism as kind of an on-ramp to establishing a credit history. But if you do use something called a secured card, it's not a true credit card, and it works this way. And again, I'm not over familiar with where these come from and how you access them. Apologize for that. Make sure that information is being captured by the credit agencies, by the person who's issuing you that card, or the company that's issuing that card, and that you're getting credit for that behavior, and then get to a real credit card or a charge card as soon as you can to make it a more seamless observation and recording of your behavior. If that makes sense. Where to get credit cards? If you've never done this before, I think Anthony did a great job here too as well. Places where you open your checking account, your primary bank for a checking account. Go to bankrate.com. We actually did this. We were planning a big trip and we wanted to try to maximize the benefits of a card, whether that was interest rate, if we were going to exceed a number. Mostly for us, it was rewards, like what was that card really offering from a reward standpoint. It also might be an annual fee on a card. Some cards will charge you an annual fee. It doesn't mean that that's something you should never pay. It's more of a trade-off to look at what that fee is getting you for what the card is offering you. So there might have been a modest annual fee on a card, But for us, maybe the rewards that were associated and the size of the credit were so convenient for us and appropriate for us that we didn't mind paying a small annual fee. So it says review no annual fee offers for any limitations, because no annual fee might come with, a very high interest rate or a very low maximum credit availability on the card. And reviewed this, it says, for any hidden costs. Is it really, can you really use the points anywhere? Are these points transferable? If you're trying to really use it as kind of a cash management tool, I think you really want to dig a little bit deeper. And that says, again, my most important thing on the slide, the last two: late fee and interest rate penalties if there's a late fee incurred, because you're going to incur, well, you can incur a couple things. You can incur the late fee, you can incur interest on money unpaid, but can be an interest penalty. So it's like you could really be, triple teamed by the credit card company if you're not careful in reading the fine print. Way to avoid that: pay bills on time, don't get there. But if you have to pay interest, try not to ever pay anything that's late, because there can be additional fees on top of that, which you don't want to incur. It talked about here, this is, and I'm going to skip over this slide. This is all these presentations are available in the archives of PSS under Money Made Simple University. But this is basically some other protections, not just New York, but across the gamut of credit cards, to give you more protection. I think the most significant things are the warnings, I guess, about penalties on the monthly bill. And then the third bullet, this minimum payment warning. This is significant, and a lot of people don't realize how insidious credit cards can be. But if you've been around the block, you've kind of heard this before, and this kind of spells it out for you. It shows you how long. So this is something they literally put in print on your credit card, which they legally have to now. How long it will take to pay off your current balance when only the minimum payment is made. It will also show you the total interest that they're estimating is going to over that period of time if you pay the minimum payment, and the additional payment needed to pay off the balance in 3 years. So what it does is it says, here's the worst case scenario if you just make minimum payments, because that interest compounds against you. Remember when Anthony and you were talking about budgeting last week, it was all about how to create positive cash flow at the end of every month, so you can actually have investment accounts where investments and or interest on fixed income investments will accrue to you and your money will compound. This is almost like reverse compounding. It's working against you because you're paying an interest rate, and you're paying interest not only on the outstanding balance, but on the interest that's been accruing to that balance. So the only way to beat that is to not pay a lot of interest. If you can, pay off balances as quickly as you can. And they also want to show you or encourage you to say, look, if you paid it off in 3 years, look how much better things would be versus if you just met minimum payments and maybe it's going to take you 20 years to pay this card off, even a small balance. So I do want to look at an example of, well, they talk about common types of debt, managing debt, credit card debt, car loans, mortgages, etc. They talk about average balances. I always say none of the averages matter. It only matters is what your situation is and what you need to do to get your numbers straight and to get to a behavior that you're comfortable with and that works for you. Okay, so it's going to be an example. It's going to be some numbers that are going to come at you a little quickly, but they talk about, and what the credit agencies look at and what another creditor might look at if they look at your report is, what's going on? Are your loans in good standing? Do you have any delinquent accounts on this report? Have there been any charge-offs, any judgments, any garnishments, any bankruptcies, right? We're not going to talk about that specifically, but you kind of know 13 is better than the 7 for you. You keep things. It stays on the report a little less time, and it shows your ability and your willingness and your behavior to pay back. But how do you control this on the report? What does this look like? And I talk about wage garnishment again, not important for what we're looking at. 4 ways to get out of debt and or simultaneously improve your score. Do it yourself. Highly recommended. You're fully capable of doing this. It just takes a little practice and a little time and a little good behavior. Debt consolidation, again, good idea. We're going to talk about how to do that when you've got multiple cards staring at you. And then the debt settlement, I'll say it now because we're going to run a little tight on time, is working typically with nonprofits or third-party agencies that can help you for either a modest fee or no fee, pro bono work, to settle debt by working with your creditors directly. And then credit counseling, I'd kind of put into that category, but debt management, I'd be a little cautious of because of I don't want to say the vendors that you might not want to deal with, people that are opportunistic in ways that it'll help them, but will not help you in terms of managing your credit score. It might ultimately get you out of debt, but it's not the most effective way to do it. And also there can be a negative impact to your credit ratings in doing it that way. So DIY and debt consolidation are probably the best. So let's talk a little bit about ways to control your debt if you're kind of doing it yourself. Don't use your credit cards. Well, that's easier said than done. Think about your habits. This goes back to what you talked about with Anthony about budgeting in the first place. Focus on one card at a time. And she poses the question like, is it better to start smart with the smallest balance that's outstanding or your highest interest rate? So we're not going to poll because we're running a little tight on time, but mathematically, the answer really is your highest interest rate because that's working against you, right? In terms of time. Look at my time here. Okay. So this is the best way to look at it. You're going to pull out that piece of paper, as ugly as it might be, and list the total amount of debt that you owe, the interest rate per that piece of debt on the card, the minimum payment that they're asking you to pay so you don't incur interest penalties or late fees, and then rewrite the list showing the highest interest rate first. So here's what they do in this example, and we'll go through it a little quickly. Different credit cards going down the left side, the amount of debt, total debt outstanding on each of those cards, what their interest rate is, what they're saying their minimum payment is, which is a combination of interest and a little bit of principal being paid back, and then what they suggest as a monthly payment, which kind of, well, what we're suggesting as the monthly payment to try to solve this problem. So don't look at that last column yet. Look at the other 4 columns. That's what they're telling you should do, the minimum monthly payment. What Anthony is suggesting, and I agree completely, is you want to get rid of the most expensive debt first because it's all interest. It's all you're paying interest on all of these outstanding balances, but the more interest you pay, the worse it really is. So even though they're only suggesting, and we're just assuming you have $650 a month to attack your credit cards, they're saying don't do the minimum payments. Go to the final column, put as much as you possibly can of that $650 towards the MasterCard because you're paying the most interest on that. You're paying 29.95% on that. So you'll be able to get rid of that card first. She kind of calls this avalanche approach of like, let me just tackle the mountain first. Let me go after the biggest debts first, the biggest, not nominally the biggest debts. This is 1,500, so it's still a pretty big number. But let me go after the highest interest rates first and just keep doing that until you get rid of that MasterCard completely and then start to work your way down the list. That's one way to do it. Probably the best, mathematically, the best way to do it. And then here it says, well, but she calls it not the avalanche approach, but kind of a snowball approach. How do you systematically get rid of everything else? So I'm going to say still go back and do what we just did. Go back and get rid of that biggest, highest interest rate first, and then start to look at how you're going to get out of the rest of the debt. So let me go back one second. Previous slide. So instead of, let's go back one more. Instead of that, let's pretend that that was gone, that MasterCard was gone. What you might consider doing, and this is more, I say, is more snowball when you come to budgeting, is then pick on some of the smaller balances, maybe that Macy's card or that Home Depot card or the Barnes and Noble card. And because even though they're not all the highest interest rates, although Macy's and Home Depot are pretty high as well, even that Barnes and Noble card, if you can eliminate just the number of creditors you have outstanding, that psychologically can add to your ability to not feel overwhelmed and to feel like you're making headway. So again, my thought is avalanche before snowball. Go after that highest interest rate first. And then if you've got a lot of cards, you just want to get rid of some smaller balances, don't do minimum payments. Do the minimums on the ones that you have to, and just keep allocating those bigger dollars to the smaller balances until those balances disappear. But clearly, it's really a question of rates first and balances second. Okay. This is all this conversation about, it's more of your head over your behavior. What are you doing? What are your goals? Don't buy things that you can't afford. Do things to try to systematically improve your debt situation and improve your savings and investment. It says explore debt consolidation. You have to have the ability to pay back. So even if you go to a counselor to talk about how you get out of debt, if you're really struggling to do it as a DIY, they're going to ask if the numbers stack up. Like, do you have the resources to actually pay down the debt? Is there enough income? You mentioned that before. Like, my income is fixed. I have a real issue with the ability to actually pay. And then how is it going to work? If you have to go through this, they talk about using things like personal loans or zero balance cards. That is not meant to be a trick against the credit companies. to trick one or the other. It's a system to try to systematically get rid of balances that are eating you alive by getting either a zero interest card where you can consolidate, as long as you have the income and the financial wherewithal and the behavior to pay down that new card. It can make perfect sense to consolidate, to literally get that zero interest rate loan or credit card and do a cash advance against it. Sometimes you
Question.
have to pay for cash advance. Yeah, question. I'm sorry.
What
Go ahead.
psych what FICO score is considered good credit?
Well, I'm not going to go back because it'll take me too long to search for it, but um, it's all in that one chart that we saw back there, which showed about 40 something percent of the population has a score of 750 or over. They're considering that to be, I'd say, excellent credit, good plus credit. You go lower than that, the percentages are lower, and it really shows up in interest rates. So it's not like you could have, a score in the 400s, and that's not good. I mean, we're going to call it that's a bad number. Um, I think generally, if you're like 650 plus, you're probably good. You go north of 700, specifically north of 750, it's really considered to be very good to excellent credit. You go above 800, it's excellent credit. And to tell you now, like we were looking, we may or may not do a loan on this car, but the real world impact of those numbers was to some extent not that great. I think it was like for excellent credit, like an 800 plus credit rating. Um, I think the rate was going to be like 6.49%. And I think the rating on, I'll say anybody and everybody, because they still want to sell a car, right? It was something like 7.9%. So that's not immaterial, but you would think it would be a much larger percentage. And again, I don't say that to dismiss the significance of even a difference of 1.5%. We know that over time works against you. So sadly, the higher that rate, the better, especially now in a high interest rate environment. But it's been less meaningful even for people with high credit scores because rates have just been high, and it's kind of been hurting everybody. But I'd say you want to get clearly above 650, probably above 700 to be considered good, good or better. And then clearly north of 750, 800, you're getting into kind of the excellent range. Here, these are other ways, and we're not going to spend a ton of time on it. Hardship plans. I always say a couple things. Talk directly to the credit card companies that you're dealing with, and say what your circumstances are. And if the person you get on the phone doesn't seem to be the person that can help you make the decision, get to somebody else. Because I think the third bullet's the most important. Explain you don't want to file for bankruptcy or use a debt settlement company. Get everything you possibly can in writing from the creditor itself, because they don't want you to declare bankruptcy either, because they'll get nothing. They would rather get pieces of something for an extended period of time until they believe you can work things out, even if it's a reduction in your balance outstanding. This is really what you do. That's what a hardship plan is. It's kind of negotiating with them directly, and it may affect your credit rating for a period of time, but better that than a full-on bankruptcy. So it's really communicating. Don't run from them. That's the natural tendency. It's like, I may figure out a way. I'll figure this out by myself. Don't. And if it doesn't work, if you can't get the snowball to start to work to your advantage, the income doesn't support it, other sources of income don't support it, then you've really got to get some counseling and try to figure out some sort of a hardship plan and work with them and negotiate with them before you really hurt your credit. And they talk about, collections agencies. All they're saying is here, you'll oftentimes what the credit card companies will do is they'll say, okay, we've given up. We're no longer trying to collect this, and they put it to an agency. That always kind of gets scary because you don't know who they are. Do they legally have an ability to dismiss your debt? And oh, by the way, how is that going to affect your credit rating because you have a debt that's outstanding? So, you need something from them in writing, proof that they actually own the debt. They took it over from XYZ insurance company, and what your payment history has been. It just gets, I won't say unwieldy. To some extent, this is how things can happen. But if you get to the collection agency stage, you have to do even more to protect yourself, that they are who they say they are, and that they're working to try to help with the debt. And then beyond that, here it comes, get everything in writing as much as you can. Get them to report to the collection agency exactly what they did. So if you're negotiating a payout, if you can afford to do that, that it's being documented, because it's no longer the credit card company that lent you the money that's actually reporting to the agency. They've kind of dismissed it and kind of written it off. It's this collection agency, And if you're not documenting things as you go, you're potentially damaging your credit rating even a bit further. In New York, it talks about, this has actually changed. I think as of April of 2022, there's a statute of limitations on this unsecured revolving credit card debt, where it's actually now 3 years after the last payment. So this sounds like a little too good to be true, but if you can't afford and haven't made payments on unsecured debt, credit card debt, like, just credit card purchases, unsecured credit card purchases, and you haven't paid for 3 years, now was six, um, the debt can no longer be collected by the credit card companies. That's if you haven't paid. So it sounds like, well, this is great. Everyone's just going to kind of welsh on their obligations. No, because you're ruining your credit rating for the 3 years that you're not paying your bills, obviously. And be very careful too. And this isn't meant to say, game the system, but if you do repay after the 3 years have expired, you're fully liable for whatever debt was still outstanding. So you have to be very, very careful. New York definitely works to your favor in this area. But again, this is an area where if you're taking advantage of the law and the favorability of the New York law specifically, you've also really hurt your credit card, your credit rating with FICO, because you haven't been paying for a number of years on your debt. So again, the website in New York will show you some good information on this. Pursue debt settlement. It talks about, this is something that I don't suggest, and it's because of that second line where it says your bills go unpaid. This is if you're working with a company that's trying to do things for you. A, are they documenting properly? Are they reporting properly? In many cases, they're not. They're just accumulating money to pay off your debt that you could kind of do yourself. They're trying to negotiate a better rate with the collection agency or the credit card company, and your credit rating is just taking a hit all along the process. So I say debt settlement is not really an option. It's not something you really shouldn't be doing, and you really can't do it for the big secured stuff like your mortgage in the first place. It's definitely something you want to stay away from. This is the better suggestion for debt management. Work with a reputable nonprofit, a counselor that could help you with budgeting, pay the agency. It might be a nominal fee, an hourly fee, and have them help you with everything across the board if you've got a variety of different types of debt that are out there. Bottom line is the DIY is make sure the income can support the plan to get you out of debt. Use an avalanche snowball combination to get you out of debt systematically, and slowly build your assets and slowly get that budget on the right side again, and work your way out of debt and improving your credit score. Once you get beyond that, your score is not typically going to improve until debt is written off, and oftentimes that's at a high expense through bankruptcies that stay on there forever, or liens or judgments that just stay on those reports for a very long time. Here it says, when you do that, all your accounts are closed. You get the fact that a counseling agency is referred on the report, which is a bad thing because they think, okay, you really need help. You can't do it yourself. And it doesn't stop any pending legal action. They can still come after you for the debts that are outstanding. What it does do is it can reduce your interest rates, your interest fees that are being charged. Usually collection calls will stop. They don't have to. And it does say that there are fees set by regulators. So again, New York gives you a little bit of a benefit there in pursuing some sort of debt management plan. But again, I think this is stuff of later or last resort. The first resort is kind of a DIY and or a counselor, a nonprofit counselor to help you. And here's the suggestion: don't use a debt settlement company. If you want to take a snapshot of the screen or catch it in a replay, getting financial assistance from some of these associations, and also the public library, the Science and Business Lab of the Public Library has some phenomenal resources that relate to credit crisis counseling if it really becomes an issue for you. So that nypl.org, SIBL, is a great resource. We've actually done some money management seminars and money matters seminars right at the library, and they're just wonderful hosts, but also a wonderful resource for you. Practical tips: get that credit report. Notify the Bureau immediately if you see anything inaccurate on the report. Never forget the rule, up to 30%, never more than 50, right, on credit limits, and only pay with cards really what you can afford to pay. Don't go into debt in the first place. There's some websites here. For bankrate.com is probably the most for looking, where to get credit information in the first place. And then just some other sites for if identity theft, which we're not going to have time to go into, presents any type of an issue for you. in terms of how that impacts your credit report, but also any legal advice you might need. Some resources right for New Yorkers. So this CLARONYC.org for civil legal advice and resources, and a couple, again, New York City based neweconomynyc.org hotline. And I still go back to the original Department of Financial Services that we had on one of the prior screens as just a tremendous resource for everything that New York is doing, but also everything that New York offers that's really advantageous to New York state residents. Let's see, I know we're right at our time. We're a little over our time. That is me. You're welcome to email me, call me with any specific questions. I would encourage you going back to, and let me just end it. Well, keep it up there for a couple of seconds if you want to take a screenshot of that. Just go back to, I just want to put up that one slide that talks about the pro bono opportunity there. Oh, she's got it. She listed it again. So the www.pssusa.org/MMS for Money Made Simple. That is for you to try to set an appointment with somebody. I think they do them on Thursdays over a short time window, a 30-minute session to just answer specific questions you have. If I can't do it by way of my email or my phone number, or if I don't have the information, Anthea and the rest of her team would be happy to work with you. I apologize for going over time a bit. I thank you, Jeff, for facilitating, and appreciate everyone's time and attention.